Hey everyone, welcome back to Investing Talk podcast. Today we're going to be looking at Senseonics Holdings,
Oh yeah, SENS.
SENS ticker symbol.
This is a company making some serious waves in the diabetes care world.
Yeah, and I think what's interesting is we're seeing their stock price absolutely skyrocket recently.
Yeah.
And we've got, hard data and market trends all pointing to something really big happening with
Yeah,
Senseonics.
absolutely.
So let's break this down for our listeners. We're seeing the SENS stock price up over 80% just recently.
That's pretty incredible.
It even hit a 52-week high of 76 cents on January 10th, 2025.
Wow.
That's some serious momentum.
Yeah.
What is fueling this incredible climb?
Well, the main driver here is the successful launch of their SENS 365 continuous glucose monitoring system.
Yeah.
It's CGM.
CGM.
It's a total game changer in the field of diabetes management.
For our listeners who aren't familiar, tell us more about this SENS 365.
Okay.
What makes it so groundbreaking?
Well, imagine this a world where managing your diabetes doesn't involve constant finger pricking.
Oh, that would be.
Yeah, that's what SENS 365 offers. It's the first and only FDA-approved CGM that lasts for a full year.
Wow.
No more daily sensor changes.
That's a huge win for patients.
It is a huge win for patients, for sure.
That sounds like a dream come true for anyone dealing with the daily hassles of diabetes management.
Yeah,
But does the market share reflect that enthusiasm?
absolutely. Senseonics reported a 56% increase in their global patient base.
Wow.
They're up to 6,000 patients now, and they had a record high of 600 new patients just in December.
Yeah.
When you see numbers like that, it's a clear sign that the market is embracing this technology.
So we've got exciting technology, a rapidly growing patient base, and a stock price that's on fire.
It is.
Does that mean SENS is a guaranteed home run for investors?
Well, not so fast.
Okay.
While the momentum is exciting, we always need to dig deeper and look at the company's financial health. Remember, a rising stock price doesn't always tell the whole story.
That's a great point.
Yeah.
What do the financials tell us about Senseonics?
It's a bit of a mixed bag, honestly. On one hand, they reported a decrease in net revenue to $4.3 million for Q3 of 2024.
Uh-oh.
And they actually posted a net loss of 4 cents per share for that quarter.
Okay, so not all sunshine and roses then.
Right.
That sounds a bit concerning, especially with the stock price soaring.
It's definitely something investors need to be aware of. But here's where things get interesting. They're projecting a significant jump in revenues starting in Q1 of 2025.
Okay.
And that's directly tied to the sales of SENS 365.
So they're banking on this new product to turn things around.
Yeah.
Do the numbers support that optimism?
They've actually released some preliminary results for Q4 of 2024, and they're expecting revenues of about $8.3 million.
Okay.
That would bring their total revenue for the year to about $22.5 million.
That does sound promising.
Yeah.
But can they sustain that growth? And what about their overall financial stability? They have the resources to achieve their ambitious goals.
Well, they currently have about $74.9 million in cash and equivalents.
Right.
That gives them a decent runway to pursue their growth initiatives and weather any potential storms.
Okay, that's good to hear. So we've got a company with a potentially revolutionary product, a growing customer base, and a decent cash position. But they've also had some financial hiccups.
Right.
How should investors be thinking about all of this?
That's the million-dollar question, isn't it? To get a clearer picture, we need to consider the broader market context.
Okay,
How is Senseonics performing in relation to the overall market trends?
that's a great point. What's the current state of the stock market, and how does Senseonics fit into that landscape?
The market has been a bit volatile lately, with the S&P 500 experiencing some declines recently.
Yeah, I've noticed that.
But here's what's interesting. Large-cap growth stocks like Senseonics have actually outperformed the market.
Hold on, can you explain what large cap growth stocks means for our listeners who might not be familiar with that term?
Of course, large cap refers to companies with a large market capitalization.
Okay.
Basically meaning they're big, established companies.
Okay.
And growth stocks are those that are expected to grow at a faster rate than the average company.
Got it.
So despite the market's ups and downs, investors seem to be betting on companies like Senseonics that have strong future prospects.
So even though the market's a bit shaky overall, Senseonics seems to be riding a wave of optimism.
Exactly. And this positive sentiment is further reflected when we look at the technical indicators for SENS.
Okay, let's dive into that.
Yeah.
You mentioned technical indicators earlier.
Yeah.
For those of us who aren't Wall Street wizards, can you explain what these are and what they tell us about Senseonics?
Sure, technical indicators are basically signals based on the stock's price history and trading volume.
Okay.
They can help us identify trends and potential buy or sell signals. For Senseonics, all the key moving averages, the 10-day, 20-day, 50-day, and even the 200-day are pointing towards a buy.
Interesting.
That's a strong bullish signal.
So we're seeing positive signals from both the market trends and the technical analysis. It seems like everything's coming up roses for Senseonics.
Well, almost. There's one technical indicator that's flashing a bit of a cautionary signal, the RSI, or Relative Strength Index.
Okay, back up for a second. What exactly is the RSI and why should we care about it?
The RSI is basically a momentum indicator.
Okay.
Think of it like a speedometer for the stock.
Okay.
It measures the speed and magnitude of recent price changes. An RSI above 70 typically suggests that the stock might be overbought,
Okay.
meaning it's risen too far too fast and could be due for a correction.
Ah, I see.
And right now, Senseonics RSI is sitting at about 74.77.
Even though the overall trend looks bullish, this high RSI suggests a potential dip in the near future.
It's definitely a possibility. This doesn't necessarily negate the positive outlook, but investors should be aware of this potential volatility.
So it sounds like a bit of a proceed with caution situation.
Exactly. Prudence is always key in investing.
Right.
But it's not just about market trends and technical indicators. We also need to consider the company's strategic decisions and how they're positioning themselves for future growth.
That makes sense. What are some of the key strategic moves that Senseonics has made recently?
One of the most significant is their decision to cancel the reverse stock split they had planned.
Now, for our listeners who are new to investing, can you explain what a reverse stock split is and why canceling it is a big deal?
Sure, a reverse stock split is basically when a company reduces the number of outstanding shares, which increases the price per share.
Okay.
Companies often do this when their stock price is very low to avoid being delisted from an exchange.
Makes sense.
By canceling the reverse split, Senseonics is signaling confidence in their ability to grow their stock price organically.
So they're putting their money where their mouth is, so to speak.
Exactly.
They believe in their future prospects enough to avoid a maneuver that can sometimes be perceived as a sign of weakness.
Right.
And they're not just sitting back and hoping for the best. They're actively forging strategic partnerships, like the one they recently announced with Essentia.
Yeah, that's right.
Tell us more about this partnership. Who is Essentia, and how does this collaboration benefit Senseonics?
Essentia is a global leader in diabetes care,
Okay.
known for their blood glucose monitoring systems.
Okay.
This partnership gives Senseonics access to Essentia's extensive distribution network and marketing expertise, which could significantly boost their market penetration and sales growth. Yeah, it's a smart move. By leveraging Essentia's established infrastructure, Senseonics can focus on what they do best, innovating and developing cutting-edge technology.
So they're playing the long game. They're not just looking for quick wins, but building a solid foundation for sustainable growth. But let's be realistic for a moment. Every company faces challenges. What are some of the hurdles that Senseonics needs to overcome?
One of the biggest challenges for any company in the growth phase is managing their cash burn rate.
Can you explain what cash burn rate means for our listeners who aren't financial experts?
Of course, cash burn rate is essentially the speed at which a company is spending its cash reserves. It's a critical metric for young companies that are not yet profitable.
Right.
They have about $74.9 million in cash on hand.
Right.
But how long that lasts depends on their operating expenses and how quickly they can start generating consistent profits.
So it's a race against time.
Yeah.
They need to ramp up revenue and become profitable before they run out of cash. Are there any other financial red flags investors should be aware of?
Debt is always something to keep an eye on. We don't have specific debt figures in the information we have, but it's crucial for investors to scrutinize their debt to equity ratio.
Right.
A high ratio could indicate potential financial strain down the road.
Okay, so we've got this exciting, innovative company with a lot of potential, but they're also facing some financial headwinds. How should investors weigh these competing factors?
It's a balancing act, as with any investment. The key is to assess whether the company's financial fundamentals are strong enough to support their ambitious growth plans. On one hand, we have the impressive growth of ever since 365
Right.
and these strategic partnerships that could significantly boost their market share. On the other hand, we have to consider their cash burn rate and potential debt burden.
So it's not a slam dunk. Investors need to do their due diligence and carefully weigh the potential rewards against the risks involved. Now let's shift gears for a moment and talk about the broader market context. We touched on this earlier, but I want to dig a little deeper. You mentioned that large cap growth stocks have been outperforming the market despite the recent volatility. What does this tell us about investor sentiment and how does it relate to Senseonics?
It suggests that investors are willing to take on a bit more risk in exchange for the potential of higher returns. They're looking for companies that can deliver growth even in a turbulent market.
Okay.
And right now, Senseonics seems to fit that bill.
But as you pointed out earlier, markets can change quickly.
They can.
How can investors stay ahead of the curve and make sure they're not caught off guard by sudden shifts in market sentiment?
Staying informed is key. Pay attention to market news, economic indicators, and expert analysis. Don't just rely on your gut feeling or follow the crowd.
So knowledge is power.
Exactly.
The more you understand the market forces at play, the better equipped you'll be to make sound investment decisions. Now let's revisit those technical indicators we talked about earlier. You mentioned that most of them are pointing towards a buy for Senseonics, but you also flagged the RSI as a potential cautionary signal. Can you elaborate on why that RSI is something investors should keep an eye on?
Sure. Remember, the RSI is a momentum indicator. It tells us how strongly the stock price has been moving in a particular direction. An RSI over 70 suggests that the stock might be getting overheated. It's like a car that's been running at full speed for too long. It might need to slow down or even pull over for a bit to avoid overheating.
So it's not a red light, but more like a yellow light,
Right.
signaling that investors should proceed with a bit of caution.
Exactly. It doesn't mean that the stock is going to crash, but it does suggest that a short-term pullback is possible.
So what are some strategies that investors can use to manage that risk?
One option is to buy in gradually, rather than putting all your eggs in one basket. This helps to average out your purchase price and reduce your exposure to volatility. Another strategy is to set stop-loss orders, which automatically sell your shares if the price drops below a certain level.
Okay.
This helps to limit your potential losses.
Those are smart strategies for any investor, regardless of the specific stock. But Senseonics has also been making some strategic moves of its own to position itself for success. We discussed the cancellation of the reverse stock split and their partnership with Essentia. Are there any other decisions or initiatives that stand out to you?
Their focus on research and development is impressive. They're not just resting on their laurels with SENS 365, they're continuously investing in new technologies and improvements, which is essential in a fast-paced field like diabetes care.
So they're playing offense, not just defense.
Right.
They're not content with simply maintaining their current position. They're actively seeking to expand their lead and stay ahead of the competition.
Exactly. And that's a good sign for long-term investors. It shows that the company has a vision for the future and is committed to innovation.
This has been an incredibly insightful discussion. I'm sure our listeners are starting to get a good grasp of Senseonics Holdings, its potential, and the challenges it faces. But before we wrap up, I want to touch on something we haven't explicitly addressed yet, the human element.
That's a crucial point. While we've been analyzing financial statements and market trends, it's important to remember that Senseonics is ultimately a company that's impacting people's lives.
Exactly. Their technology has the potential to make a real difference for millions of people living with diabetes. Imagine the freedom and peace of mind that comes with not having to constantly worry about finger pricking and blood sugar levels.
It's a game changer, not just from a technological standpoint, but from a quality of life perspective.
Right.
And that human impact, that ability to improve people's lives, is something investors should consider.
It adds a whole other dimension to our analysis.
It does.
When a company is driven by a mission to make the world a better place, it can be a powerful motivator for success.
Absolutely. It's about more than just profits and losses. It's about making a positive impact on society.
So as we wrap up our discussion on Senseonics Holdings, let's leave our listeners with this thought. SENS is more than just a stock ticker.
Right.
It represents innovation, potential, and a commitment to improving the lives of people with diabetes.
Whether you're a seasoned investor or just starting out, this conversation has hopefully given you some valuable insights into Senseonics and the factors to consider when evaluating any investment opportunity.
Remember, knowledge is power. The more you learn about a company, its market, and its potential, the better prepared you'll be to navigate the complexities of the stock market.
And never stop learning. The world of investing is constantly changing, so stay curious, stay informed, and never be afraid to ask questions.
That's great advice. This has been a fantastic deep dive into Senseonics Holdings. Thank you for sharing your expertise with us.
It's been my pleasure.
And for our listeners, if you're interested in learning more about Senseonics or exploring other investment opportunities in the healthcare sector, be sure to stay tuned to Investing Talk podcast.
We'll continue to bring you in-depth analysis, expert insights, and everything you need to make informed investment decisions.
And don't forget to subscribe to our podcast. Share this episode with your friends and leave a comment below with your thoughts on Senseonics. We love hearing from you. Until next time, happy investing.
Yeah, it really is. It's amazing to think about the impact this technology could have. We often get caught up in the numbers and the charts.
Yeah, for sure.
But at the end of the day, investing is about supporting companies that are making a real difference in the world.
Absolutely. And when you invest in a company like Senseonics, you're not just betting on their financial success.
Yeah.
You're investing in a future where diabetes management is less burdensome and more empowering for millions of people. That's a powerful message for investors to consider. But let's shift gears for a moment and talk about some key metrics that investors should be looking at when evaluating Senseonics or any company in the healthcare sector. What are some of the numbers beyond just revenue and earnings that can give us a better understanding of a company's financial health?
One important metric is the gross margin. This tells us how much profit a company makes on each dollar of revenue after accounting for the cost of goods sold. A healthy gross margin indicates that the company is managing its production costs efficiently.
So a higher gross margin is generally a good sign, right?
Exactly. It means they're keeping more of their revenue after covering the costs of making their products. Another key metric is the operating margin,
Good.
which factors in operating expenses like marketing and administrative costs.
Right.
This gives us a clearer picture of the company's overall profitability.
So it's not just about how much money they're bringing in,
Right.
but also how effectively they're managing their expenses to turn that revenue into profit.
Precisely. And of course, we can't forget about the debt-to-equity ratio, which we touched on earlier. This measures how much debt a company is using to finance its assets. A high debt-to-equity ratio can signal potential financial risk.
It's like checking the foundation of a house.
Yeah,
You want to make sure it's solid and can support the weight of the structure.
that's a great analogy. By analyzing these key metrics, investors can gain a deeper understanding of Senseonics' financial health and assess its potential for long-term growth.
This has been a fantastic discussion of Senseonics Holdings. We've covered their exciting technology, their recent market performance, their financial standing, and their strategic moves. What are your final thoughts for our listeners as they consider whether Senseonics is the right investment for them?
Senseonics is undoubtedly a company with a lot of potential. They're operating in a rapidly growing market, and they have a groundbreaking product that addresses a significant need. Their strategic decisions, like partnering with Essentia and canceling the reverse stock split, show that they're thinking long-term and taking proactive steps to position themselves for success.
But as with any investments, there are risks to consider. They still need to prove that they can convert their promising technology into sustainable profits and navigate the challenges of a competitive market.
Exactly. Investors should carefully weigh the potential rewards against the risks involved. Pay attention to their upcoming earnings reports, track their progress in growing their patient base, and keep an eye on their debt levels.
It's a company worth watching.
Definitely.
But remember, investing always involves a degree of uncertainty.
Yeah.
Do your research, understand your risk tolerance, and never invest more than you can afford to lose.
Well said. And never be afraid to seek out expert advice if you need help making informed investment decisions.
This has been an incredible discussion. Thank you for sharing your insights with us today.
It's been my pleasure.
And to all our listeners out there, thank you for joining us on Investing Talk Podcast. If you enjoyed today's show, please subscribe to the podcast, share it with your friends, and leave us a comment below. We love hearing from you. Until next time, happy investing.